Welcome to the video. For more great tips, strategies and to access your free expert downloads, please go to www.improveyourbusinesssuccess.com.
Hi and welcome, this is Mark Taylor, Managing Director of KeysToSuccessClub.com, and this is part of our business series, and today we're going to be talking around financing your business. So financing your business is obviously mission critical, and typically you're going to have some capital, and the different sources you've got, and it really depends how you're set up. But if you take an emerging business, most people would put their own money to start with. They'd invest their own funds. They could look at getting a bank loan or a business loan as well. The other option then you've got are friends or families, so mates, friends and family investors. And then you're moving into external parties who you may not know, and they're typically angel investors. So angel investor is more typically a successful business person who's working as a solo investor looking for businesses. They can give you capital. They typically want to be having a quite hands-on role, so you need to be careful about that. And they tend to operate quite difficult to track, and they normally get in through referrals and networks, so it's quite hard to actually tap into a solid angel investor network unless you have some personal contacts. After that, you'll be looking at more professional capital injections through either venture capitalists or private equity players. Now they would typically go for bigger plays in terms of capital. So if you put numbers on it, you might be looking at $10,000 to $50,000 Australian from your own personal. You might be looking at 100,000 to 200,000 through friends, families. You may be looking at 250 to 500 for your angel investors. Now the venture capitalists tend to be kicking in at a 1 million plus, and more often in Australia and UK, more the 2 to 3 and 5 million dollars, and the private equities over and above that. So that's your frame reference of the capital injections that people will need. The other way you can do it, and this is not always just for the largest companies you might think, but you can also go public. So by going public, you may go into different markets around the world to actually float the company and raise capital from mum and dad investors. Now that's slightly more complicated, but nevertheless there are ways of doing that through backdoor exits, merging into other companies, going through different markets that are not quite as well established as the main ones. Some small entry markets like the AIM market in the UK was traditionally a smaller market entry point. So those are your different ways of capitalizing your business. Of course, the other one is actually to self-fund, which means your business generates the money for you to invest back into the business, so you don't need any external funds. That can be great, you keep control, but it really depends on the nature of business, and sometimes people have to get external funding in order to create the leverage they need to really maximize their potential. The main thing around financing is always get more than you think you need, because it typically runs out quicker, and if you don't have enough capital and you do run out of money, then it's a very bad place to be. So you always try and get more capital than you need, and make sure you've got plenty of buffer in there and be open to opportunities. The final left field thinking is a lot of people try and do everything they have to on their own for businesses, and often you can get suppliers and partners to actually co-invest. Now what I mean by that is, let's say you're manufacturing something. There are plenty of manufacturers who potentially do some kind of a deal or joint venture arrangement with, where they would take on the manufacturing in their factory for some kind of arrangement. So we've seen this work quite well in a lot of emerging companies, where they think out of the box and do alliances, venture arrangements with companies in the supply chain, and get their potential customers for license deals or priority market entry. Lots of creative ways you can actually get other people involved to help cover some of the costs, and of course that's very different to actually building something yourself. So think out of the box sometimes, and you'll find there's some other ways to not necessarily, you won't need as much capital because other people are doing parts of the value chain for you. So that's a little tip at the end to talk about another way of getting finance for your business. So there's plenty more on that subject. There's lots in the club on that. So that's pretty much all I want to cover there in terms of different options you need to think about and some of the numbers for financing a business. Cheers now.
Thanks for watching, and remember to check out our awesome blog at improveyourbusinesssuccess.com. Have a great day.